Everyone knows the story about Jack and Jill. They went up the hill to fetch a pail of water. Jack fell down, broke his crown, and so on. From that tale, we've all learned the virtues of indoor plumbing and properly accessorizing when completing chores. But seriously, who wears a crown to fetch water? Imagine the story, however, if Jack and Jill had gone up that hill to fetch themselves alone. Let's say they were twins who both worked for the same architecture firm, earning the same amount of money. They went to the same college, earning the same degrees, and they lived in the same area. But when they got those loans, Jill paid an interest rate 2% higher than Jack. Why would that happen? 2 words. See, Jack may be a clumsy guy, but he is conservative with his money and puts a portion of his salary into a savings account. He also pays bills on time and is careful when using his credit cards. Jill, on the other hand, she's a bit more frivolous with her money, choosing to spend it on clothes and nights out with her friends. And she doesn't always pay her bills on time. You see, when a lender decides whether or not to give you a loan and how much to charge you for it, they look at your credit score. And that means you should know what makes your credit score better or worse. In addition to your spending and saving habits, there are 5 key factors that make up a percentage of your score. Let's look at what each one means. This is how long you've had credit. The longer your credit history, the better. This is what percentage of your available credit you're using. If you've borrowed too much of your available credit, it doesn't look good. Don't get too close to your limit. Every time you open a new credit card or get a new loan, it reflects on your credit score. Don't open too much at once. It might sound weird, but it helps to have a good mix of credit in your name. Student loans, credit cards, car loans, and so on. You see, on the credit score spectrum, Jack's good habits have earned him a score of 800. That's excellent. While Jill has a score of closer to 600. Not good. The higher your credit score, the more likely you are to get a loan and get lower interest rates. In the eyes of the lender, the higher the credit score, the less risky the borrower. Why is this so important? Because one day you might want to buy a house or get a startup loan for a water fetching business, and your credit score could make all the difference.